Is your house truly an asset or a financial trap? For decades, we've been told buying a home is the ultimate investment, but is that still true in September 2025? We're diving deep into the often overlooked downsides and surprising realities of homeownership that could completely change your financial perspective. For generations, homeownership has been promoted as the cornerstone of financial security. It has been presented not only as a place to live, but as the ultimate investment and a guaranteed path to long-term wealth. Yet when you strip away the cultural pressure and emotional weight that comes with owning property, the financial reality becomes far more nuanced. Buying a home can create stability and pride, but it can also act as a drag on your wealth if you fail to consider the full picture. The first issue is the myth of automatic appreciation. Many people believe that real estate always goes up in value. While housing prices have historically trended upward, the growth is not nearly as spectacular as many assume. In the United States, for example, housing has appreciated at an average annual rate of about 3 to 4% over the last century, which is only slightly ahead of inflation. Compare that to the stock market, which has returned closer to 7 to 10% annually over the same period. Over decades, that difference compounds dramatically. If you put $100,000 into a house and it grows at 3% annually for 30 years, you end up with about $242,000. If you put the same $100,000 in a diversified stock index with 8% returns, you are looking at over $1 million. The numbers alone challenge the narrative that a home is always the best investment. But appreciation is not the whole story. The hidden costs of homeownership chip away at any gains you might make. A house is not just a mortgage. It is property taxes that rise as local governments adjust rates. It is homeowners insurance, which has increased in many regions due to risks like floods, wildfires, and hurricanes. It is regular maintenance such as painting, plumbing, and heating systems. It is also inevitable major repairs like replacing a roof or fixing a foundation. Financial advisors estimate that homeowners spend between 1% and 4% of the property value annually on upkeep. That means on a $400,000 home, you could spend anywhere from $4,000 to $16,000 every year. These expenses do not increase resale value. They simply prevent the house from falling apart. Another challenge is transaction costs. Buying and selling real estate is not cheap. Realtor commissions, closing fees, inspections, and transfer taxes add up quickly. Selling a home typically costs 6 to 10% of the home value. On a $400,000 home, that is $24,000 to $40,000 gone the moment you move. Contrast that with investments like ETFs or stocks where trading fees are negligible. Real estate is both illiquid and costly. Liquidity is a major issue. A house is a non-liquid asset. Unlike stocks, bonds, or even crypto, you cannot sell a piece of it when you need money. You either sell the whole property or you do not. If markets are down or if demand is weak, you could wait months or years to get your cash out. Worse, in downturns, you may face negative equity, where you owe more on your mortgage than the house is worth. This happened to millions of families during the 2008 financial crisis. Now let us consider opportunity cost. When you buy a house, you tie up a massive amount of capital in one asset. If you put $100,000 into a down payment, that money is not invested elsewhere. Over 20 or 30 years, the difference between housing appreciation and higher returning assets can be enormous. If the housing market grows at 3% annually, while the S&P 500 averages 8%, the gap in wealth created by your down payment can be measured in hundreds of thousands of dollars. That is money you might have used to retire earlier, or start a business, or build a diversified portfolio. The psychological and lifestyle costs are also significant. Owning a home reduces mobility. If a better job opportunity opens up in another city, renters can move with little friction. Homeowners must list the house pay commissions and risk waiting months for buyers. This lack of flexibility can limit career growth and financial advancement. Studies suggest that areas with high homeownership rates tend to be less mobile and less responsive to labor market opportunities, which drags down both personal income and broader economic growth. Still, it would be unfair to claim that homeownership is always a bad move. There are situations where buying makes sense. If you live in a city where rents rise faster than mortgages, owning can lock in costs and protect you from inflation. In countries like Canada, where affordability has been a crisis, buyers sometimes conclude that avoiding rent hikes is reason enough to purchase. If you plan to stay in one location for 15 to 20 years, the costs of buying and selling are spread out over time, and long-term appreciation combined with mortgage paydown, can work in your favor. Rental property also changes the equation. When you buy with the intent to rent out units, tenants pay off your mortgage and cover maintenance while you build equity. In this case, real estate becomes a business investment, not simply a residence. There is also the emotional value of stability. For families, owning a home means control over the living space. No landlords increasing rent or refusing renewals. You can remodel and customize freely. These are lifestyle returns, not financial returns, but they matter to many people. The issue comes when people confuse lifestyle benefits with financial gains. They convince themselves their home is making them rich when it may only be keeping them comfortable. Finally, let us examine the phrase that renting is throwing money away. This saying has pressured millions into buying homes they cannot truly afford. Yet renting provides flexibility, frees up capital for investing, and in many markets costs less than ownership. If you rent for $2,000 a month, while a friend pays $3,000 in mortgage insurance and taxes, you save $1,000 every month. If invested wisely over decades, the renter could end up wealthier than the homeowner. Renting is not wasteful. It can be a path to financial freedom. The body of evidence shows that a house can be an investment, but it is not automatically a good one. It carries hidden costs, liquidity challenges, and opportunity costs that many ignore. It can provide stability, pride, and a roof over your head, but financially, it is often less about maximizing returns and more about choosing a lifestyle. The smartest move is to treat homeownership not as a universal rule, but as one option among many, and to analyze it like any investment by weighing costs, risks, returns, and alternatives. A house can be a place of pride and comfort, but it is not always the best investment. Sometimes it builds wealth, and sometimes it holds you back. The key is to know why you are buying and to be honest about the trade-offs. Do not follow the myth blindly. Think about your goals and make the choice that fits your life. The best investment is not always the roof over your head. The best investment is the freedom to control your money and your future.